Monday, the 1st of February. Good morning. It's a bit cold for shorts. Well, the past couple of weeks has brought many changes. We have seen the transition of leadership in the US finally go ahead without too much drama. Positive vaccine progress in the UK and riots in Holland of all places. Meanwhile, we're still in a state of lockdown, which is extremely tedious and I know is having a devastating impact on different parts of our society. I do feel that the mood is changing, however. A recent communication from our local health board shows that cancer treatments and operations have resumed in Carmarthen and Haverfordwest is to follow imminently. Numbers of positive CV-19 tests are firmly falling across Wales and the UK in general. Reports of several new vaccines that will be made again in the UK really boosts our chances of getting out of this quagmire. I think we've all come to the acceptance that 2021 is going to be fairly restricted. However, we need to get our children back in school, our workers back in jobs, and our retail economy running again. It's fairly clear now that the collective intention is to get this done by the spring. The cost to the UK finances of the ongoing furlough scheme is eye-watering and just can't continue. But what about markets and our portfolios? Anyone watching the FTSE 100 over the past couple of weeks may feel concerned at its steady decline. Those early Brexit deal rises have now been lost. But why? Well, the lockdown will have had a large part to play in this, and I don't think the media have focused nearly enough on that. However, there's an issue happening in America that I want to address called short selling and a synthetic stock bubble. Bear with me. Whenever an economy is struggling, central bankers will turn on the money taps. This is termed as widening the money supply. Imagine pouring water from a watering can into a bottle. The spout of the watering can is very thin, and the water comes only as a trickle. The water does go into the bottle, but very slowly. Now, imagine the central banker comes along with a pair of scissors and cuts off the end of the spout. Suddenly, water is pouring out very quickly. A lot more goes into the bottle, but a huge amount is also wasted, gushing down the sides of the bottle. This is called widening the money supply, and it's caused by lowering interest rates and pumping capital into markets so that people feel richer. Now, lock those same people up in their homes for months on end and target them with adverts on social media, telling them that they could make a lot more money with that spare cash that they can't spend anyway because they can't go anywhere. Normally, synthetic stock is the preserve of highly experienced fund managers and traders. The way this traditionally worked was as an insurance for a trader. Let's say that I think Tesco shares are going to go up and I'm a fund manager. I could buy those Tesco shares, but then go to a broker and also buy an insurance that pays me if I'm wrong. This is effectively called hedging, and it dilutes my gain because I'll lose my money on the insurance if the shares do rise. However, the insurance gives me some return if they fall. Enter the hedge fund manager. During the great financial crisis of 2008, we saw how hedge fund managers manipulated markets through short selling. They would buy the insurance that pays out if a stock falls. They would then buy as much of that stock as they could and swiftly sell it again to cause losses on that stock. They even borrowed vast amounts of these shares as synthetic stock, that's easy for me to say, from other companies, and then they dumped these in the markets too in order to cause that particular share to crash. I recall this happening with some of the banking shares such as HBOS, which were already in trouble. The only winners in this scenario were the hedge fund managers. The FCA stepped in and rightly banned this practice of short selling in the UK, which helped to steady markets. In the US, short selling has been starting up again as hedge fund managers look to make money through short-term moves on distressed stocks. However, here is the really interesting quirk. Many retail investors, that's those folks stuck at home who are not professional traders, have started buying up the distressed stock in an outright bid to counter the hedge fund managers. The retail investors have bought the other side of the insurance that prospers if the share goes up. This is all utter madness. Effectively, you have a whole bunch of people buying synthetic paper that could be utterly worthless if they end up on the wrong side of the bet, and causing huge ripples in the market whilst doing it. Water sloshing down the side of the bottle. This is the unintended consequence of widening that money supply. My humble guess is that this practice will be shut down in short order, pardon my pun. I don't see it leading to a crash. I think it's just one of a few reasons why markets are currently struggling. However, I thought you might read about this story of short selling or the Reddit story, and I wanted you to know a bit more. In admin-based news, I also wanted to mention the amount of paper that I know some of you are still receiving from Old Mutual. If you sign up for online access, you will greatly reduce your paperwork in the post. However, we're finding that there are some documents that still have to be posted to you by law, particularly when a new investment is made. This is something we're noticing currently, and we just wanted to put your mind at rest. Finally, in Thomas & Thomas news, we're waiting for an imminent update on Katie and Danny's new arrival, and we will be sure to let you know as soon as we hear anything, but I have spoken to Katie very recently, and she's doing fine. As always, we're here for you 100%. If you need anything at all, please don't hesitate to call or email me. Hang on in there. The worst is definitely behind us.